Welcome back to Incorporate, the podcast for business owners, presented by UB School of Management Center for Entrepreneurial Leadership, where we explore the strategies and real-world decisions behind building stronger, more sustainable businesses. I'm your host, Susan Steffen, Executive Director of the UB Center for Entrepreneurial Leadership, joined by our producer, Jordan Lima of Lemur Studios. Today we're talking about a powerful and sometimes overlooked path to entrepreneurship. Buying a business instead of starting one from scratch. Acquisition entrepreneurship has gained significant traction in recent years as professionals seek a faster, potentially less risky path into ownership. We'll also explore how acquisitions can serve as a strategy for scaling and increasing enterprise value once you already own a company. My first guest is Tim Delaney, entrepreneur, investor, and host of the Business Buying for Financial Independence podcast, where he shares insights on evaluating, financing, and operating acquired businesses. Tim has built and analyzed dozens of business acquisitions, and he brings practical lessons from his own experience buying and growing companies into this conversation. Joining him is Bob Neubert, Clinical Associate Professor of Entrepreneurship at the University at Buffalo School of Management and Director of Entrepreneurship Academic Programs and the Entrepreneurship Clinic. Bob combines academic leadership with real-world venture experience, mentoring students and business leaders as they evaluate ownership paths and growth strategies. Whether you're considering buying your first business or expanding through acquisition, this episode is for you. So we're going to start with Bob, and let's get a little definition here of what are we talking about, what is acquisition entrepreneurship, and why has it gained momentum in recent years?
Sure. Well, thanks for having me. It's always great to see you all. Acquisition entrepreneurship is a really exciting area. So what historically has happened is we only think of entrepreneurship from the startup mode, right? So maybe a tech startup, a spin out, but it's starting from scratch. But what we've discovered is that there's a much better way sometimes to do entrepreneurship, and that's where we identify a business that may be small. I like to target $1 to $3 million revenue businesses that have some terrific advantages and possibilities for growth. And then what we do as entrepreneurs is we buy them, and then we apply entrepreneurial methods and innovation methods to grow it. Think of it like a rocket. It takes a lot of energy to get it off the ground. But what I want to do is grab that rocket while it's already launched, and I want to take it all the way out of the atmosphere, right? So what we do at UB is we do teach startup entrepreneurship. I mean, that's certainly core to what we do. But we also teach, and we're one of the few public schools that do this, that teach how do we buy a business, how do we use financial models to then grow the business, and maybe we add some operational excellence or marketing excellence to take advantage of that growth. So acquisition entrepreneurship is a huge growth area because of the demographics. A lot of people from the baby boom generation are looking to sell their businesses. And now with AI, we can actually use AI methodologies to take those businesses to an all new level. So I'm super excited to be here to talk about the details of entrepreneurship and the acquisition of companies and how we apply that to growing businesses here in Western New York.
And Tim, you've been in this field for a little bit, kind of promoting buying a business as a path to entrepreneurship. So why might someone do that instead of starting from scratch?
I mean, I think Bob covered a lot of that. And before I get into that, thank you as well for being here. I really appreciate it. But from my own perspective, I'll just share a story. I was trying to start a business from scratch, a traditional entrepreneurship route. I was actually having these handmade custom iPad sleeves made. This was back in 2010. First iPad came out. It didn't have a cover. And it was a lot of work getting the designs, getting it made. First shipment lands, and what felt like within weeks, Apple announced iPad 2. Different dimensions, different product. Sleeve no longer was relevant. It was like, back to the drawing board. But the reality is, even if that had worked, it could have been months, years, decades before I felt comfortable not reinvesting in that business constantly to start paying myself and start actually feeling like I had a business. So buying a business, you get that head start. You already have revenue. You already have some systems. You have some employees. It's just a good launching pad you're already launched and you just kind of can accelerate faster.
Yeah. So who wouldn't be a good fit for that? Who shouldn't think of buying business? Is it for everybody?
That's a good question. I in some ways, I feel like if you can run a household, especially in today's day and age with budgets and kids' activity schedules, I know mine is chaotic. It's probably more chaotic at home than in my business. Then I feel like you could. So if you have an interest, it's really strong interest. It doesn't have to be a complete passion. I think people can do more than they give themselves credit for. If you don't have the risk aptitude, maybe not for you.
What was your first acquisition? Curious.
The wine and liquor store,
Okay.
Elma Wine Liquor. I had while I was getting this iPad or trying to get this iPad sleeve thing off the ground, another business opportunity fell in my lap. And prior to that, I had kind of discounted the idea of buying a business. My thought process was, if somebody's selling a business, either it's going to be overpriced or it's in such rough shape that why would they, they're just trying to offload it. So I didn't think there was growth opportunity when you bought a business. But that particular business kind of opened my eyes to the idea of I can use a little bit of my own capital, get a bank loan and seller financing to pay for the rest of it, and get a paycheck the first day I walk in there as the manager if I want to be the manager. It's like, that just makes a lot of sense. And so I went on a search for a while and found the wine and liquor store.
Yeah. So, Bob, do the students that you're working with in the program, do they do those searches? Like, are they helping people in the community find a business, or how does that work?
Sure. So the students that I have are thinking about actually being the person that buys the company, right? And so ultimately, I teach on mostly MBAs, and so they are mid and upper level management people. So they have operational excellence. So I'd say they're already skilled. Most of them already have some capital, right? There's ways to use 401k plans. Some of them have equity in their homes. So they do have a base to generate capital so they can secure SBA loans or other financing models. So what they typically are doing is picture a corporate mid-level manager. They're looking at maybe a 10 or 20-year process to get to a high level of income, maybe a VP or a president. Really difficult time. And today with AI, they feel the uncertainty of what that path might be, right? So what they're thinking is, I call it a bypass. They're thinking about taking a bypass around a city to go, could I get to be the president of a company in 9 months or a year? Right? If you have that construct, well, you can't do that in the typical path in the corporate world. And I had a corporate career, so I know how hard that can be, right, to climb that ladder. So what they do is they start to look to say, can I buy a business? Now, because of the demographic shift with the baby boom generation selling businesses, there's a lot of businesses that are successful. They're not being dumped for bad reasons, and they don't have a succession plan. These founders, they don't have kids that want to take over. They don't have employees to take over. So a perfect match is maybe an upper level banker or somebody that's worked in a tech company. They now have the operational excellence. Well, I think what a lot of people don't realize, even if you do a startup, once it's launched, you have to operate the company. Right? And so many people fail in entrepreneurship because they don't have any operating experience, right? So they can't do the financials, they can't do the marketing. So what I find is the students that are looking for this, they have technical skills, they have marketing skills, they can operate a business. So it's perfect. They can basically leap 20 years up the corporate path by buying a company like what you did.
And so what I hear you saying too is that and when you say students, we're talking about managers and working professionals because they're in the online MBA, but they are essentially taking a very uncertain situation that they're in their careers because of disruptors like AI or politics or whatever it is, and seeing a path to control their own destiny by acquiring a company, which is pretty interesting because I think, especially for the younger generations, that idea of being able to create, being able to drive, being able to do, and not necessarily be the loyal corporate person, I think that's more attractive than
Absolutely.
ever.
The Wall Street Journal had an interesting piece of research today. There's an increase by 69% of the people who put in their profile on LinkedIn that they're a founder this year. So there's a dramatic move. And a research-based person looks and says, one, there is uncertainty in the market, layoffs, economic problems, AI, technical changes. That's when you see a lot of people moving into innovation, entrepreneurial careers. It's a way for them to take control of their own life. What a lot of people have never thought, only elite schools mostly teach acquisition entrepreneurship methodologies. We're pretty rare in that space. When you learn about it, you go, holy cow, I can do that. I can control my own life. I can put a team together to acquire a business. And it usually takes 9 months to a year to find one. So as long as they're willing to do the diligence and not just grab the first one they see, right, to make sure they use disciplined approaches, all our MBAs are highly capable. every one of them could go buy a business. I'm certain of it.
Where are people searching for businesses?
Yeah.
Are there
Is it like
brokers?
this?
Is there a website? Is
That's
it
more your space.
Marketplace account we don't know about? Yeah.
All of those. All of them.
Everywhere and anywhere. It's really, I mean, there are dedicated listing websites. Bizbuysell.com is probably the most widely used one. LoopNet.com, which is more commercial real estate, but occasionally they'll list businesses as well. Brokers' websites directly, because you do have to remember with business brokering, it's not like real estate with the multiple listing service, the MLS. Brokers, usually sellers of businesses are trying to keep it somewhat discreet when they're listing a business. So the brokers don't go widely publish everything. And the brokers are paid by the seller in vast majority of cases. So they are keeping it in-house. So as a buyer, as somebody that's searching, you need to talk to all of the different brokers. Go to the Chamber of Commerce meetings, go to entrepreneurial meetups and networking, and just talk to people. Let's talk to accountants, lawyers, bankers, everybody and anybody, really.
Are you always trying to buy a business that's for sale or trying to get somebody to sell a business that they don't know they want to sell?
It can be both. There's a technique called a buy box, and basically what you do, almost everyone that starts at this is unsophisticated, and so that they are kind of sidelined pretty quickly by the people in this space. So what we teach our students is how to write a one-page document that clearly defines the boundaries of the kind of business they're looking for, and then we use that, and they reflect on their capability sets, what kind of business do they want to run, the geography of where they want to be, those kind of things. Once they have that, I show them, you go to brokers, accounting firms, law firms. You're really trying to build a very large network, because the best deals I found, I've been actively doing this for 30 years. The best deals I find are not for sale. Right. So there's a person thinking about it, and now this is an opportunity. But I've also found great deals for people who have been distressed trying to sell a long time. What you have to do is be a deal maker, right? And the idea is, one of the things I found is everyone thinks that the seller is going to sell you their business. I find I sell them that I'm the buyer for them, right? Because I'm gonna close a deal. I'm gonna be easy to work with. I'm gonna be sophisticated. And somebody like Tim would be able to help people that are listening to the podcast. How do you structure that buy box? How do you interact with people? But you go everywhere, right? So but you don't want to look for just any business. You want to help them understand what you're willing to buy. Is there an industry you don't want to be in? Some people might say, "How I wouldn't be in a liquor store," right? And other people go, "Yeah, I would absolutely do that," right? But I think you want to match your capability set so that you can add value to the business when you buy it. Because ultimately, I use a model where I would not buy a business unless I see a path to at least a 10% compounded growth rate for the first 5 years, right? Because what I'm looking for is when I buy the business, I want to double the valuation in the EBITDA of it. And then if I do that, I probably even increase the multiple that we buy it, right? That's a little technical, so we can get into that later. But I think you want to cast a wide path to the people and make sure that they know that you want to buy. But these professional advisors are really good sources.
This episode of Incorporate is going to use some words that you might not be familiar with. We're going to talk a lot about EBITDA and multiples. So I'm going to ask Bob to explain what those are for us.
Sure. So EBITDA is earnings before interest and taxes. And so the idea is that it's the level of profitability before the financial or tax implications. And the multiple is the amount of valuation against that. So if an EBITDA is $100,000 and the multiple is 3, people are willing to pay 3 times $100,000 or $300,000. One way to look at it, if you're used to investing in the stock market, you can look for price earning multiples. Those are the multiples that people pay against the earnings to determine the valuation of a stock.
So the multiple is a way of determining the value of the company.
Yes,
the higher
absolutely.
your EBITDA is this set number, but the multiple might change, right, depending on what industry you're in or who the buyer is or why they're buying.
Yeah, that's just to add on that. You're selling yourself as a buyer to the brokers and to the sellers. Like every time you call a broker or to try to email a broker, you want to be telling them why you are the best person for that particular business that you're talking about. And the skill set thing is big. If you're a marketer by trade, you spent 10 years in a corporate marketing department, don't go buy a business that has an amazing marketing program already. Find the business that has something else really strong, but their marketing is suffering, and you can bring the marketing and really accelerate that growth.
Well, because a part of it, I think, is if the founder is the one selling the business potentially, that's their baby, and so they want to make sure whoever buys it is either going to make it better or at least be true to whatever their values are and their roots. And so, unlike somebody maybe who buys a house and they don't really know who moves in or care, I would think they're interviewing you as much as you're interviewing them in terms of the buying process. I would think.
Yeah, you have to get along with them. You have to be able to do business and trust them and really get to know them. And a lot of business owners hear horror stories of private equity companies coming in and buying them and getting rid of all their employees and dumping everything. And most sellers don't want that. To your point, that it's their baby. They've been doing it for a long time.
So when you go in to buy a business, let's say you're successful and you win the bid, how do you convince the employees that, or maybe during the process, that this is a good thing and to stick with you, assuming the employees are part of the value that you're buying? Like, how do you gain their trust?
What I did was wrote a really nice letter to the employees and went in immediately and met them. I actually got to meet them before the transaction was closed, which isn't always the case depending on the nature of the transaction, but spending time with them, showing them that you're going to pay them, making sure the payroll goes through the first day. That's important. Because nobody likes change. Like all of us are just wired to not like change, and employees are nervous. They're scared. They think they're all going to get fired for some reason, even though that's why you're buying the existing business, is because it has the employees already. You want that, but it's just human nature to be nervous and scared and not like the change.
Well, there is a world where the business would get better and it would be better for the employees because of improvements in sales for the business and everything, right? I mean, the goal would be for it to be better for everyone.
Yeah. Try to share that vision with them. Show them your plans, that it is, I'm growing. I want to grow. I need you. You're part of this. Like you have a skill set. That's what I'm, here to tap into.
So I want to talk a little bit about what are the signs of a good business to buy. So obviously there's some financial things we need to talk about, and then there's a lot of things beyond financial. So let's assume for a second, we've come up with the industry fit and we know like this is what we want to do. But how do we know if the company that we're targeting, either the one that's for sale or the one that maybe you could convince somebody to be for sale, how do we know that that's a good target?
So every person that buys should develop their own criteria, right? So I'm a quantitative person, right? I trained as a chemist, did my MBA in finance, so I'm going to think about the numbers pretty strongly. So I'm going to make sure they work. So the first thing I think people make a mistake is that they use the seller financing models, and I don't do. I certainly use that as input, but I build all the financials from scratch, right? So I build all the pro formas, and I validate every single thing I can with any kind of data that's out or available through the business, right? So, but what I try to do is I'm looking. What I found is the best value creation for me is a company that's between 1 and 3 million in revenue, and I do that for a couple of reasons I can share now. But, if you look at the data, there's data sets that have about 30 million companies in the United States. Only about 5% exceed $1 million in revenue, right? So $1 million is kind of a hurdle, and I do that because, again, thinking like an entrepreneur, I want product market fit. I want to make sure that business is viable. I'm looking that they've done that number for a few years. And that means I'm going to eliminate about 95% of all the companies right off the get-go, right? The other thing I found is about $2 million as a rule is where people stall out. So founders who can get past $1 million stall out at 2, because at 2 million, you can't just do everything yourself anymore. Now you need teams, you need system, you need accountants, you need lawyers, you need processes, you need tech. And that's where they kind of stall, right? So what I'm looking for is I want a company that gets past that first hurdle but stalls out, because then I'm going to come in with operational marketing excellence to grow it, because growing from 1 to 3 or 5 or 10 is easy if you have the expertise. It's not if you don't. So for me, what I do is I'm going to look at that range because I'm going to bias my acquisition to being the most beneficial for me. And then I mentioned a few minutes ago, I need to see something very concrete. Like you mentioned, like it doesn't have a good marketing program. I want to know that my expertise is but it'll be utilized in a way that's going to grow at least 10%. Now, and we've had success with more than 20% growth rates, which gets you to, they call those gazelles. Now you're talking about serious number growth, right? So I'm looking for a lane. I'm very, very disciplined, no matter how good the business is. If those financials don't allow me for those outsized returns, I'm not going to do it. And it's because then all the loans and seller financing, SBA loans, all are very easy because the debt service is very easy to show that because of the growth rates and because of the EBITDA they have, you can buy the business. First day you're making you have cash flow, you pay all the employees. So I do that because then it's a rocket that's already going up, right? I don't want to go in. I personally don't want to fix a business, right? I don't want to buy a distressed business. I want to find the one that the founder can't grow to the next level and then step in and buy it at that point. I don't know if you have criteria.
That's pretty similar to that. I'm looking for something that I can grow that's missing a piece, that's stalled, that the seller, it could a lot of times it is just the seller's tired. They've been in there 20, 30 years and they don't need more money. They don't want more money. It's because they don't want the headaches that come with it. Adding more people, adding more tech. They're good, but there's something there quickly and easily that can be added, whether it's marketing, whether it's tech, whether it's key people that just can kind of accelerate that growth very quickly.
Have either of you ever looked at turnarounds, like buying distressed? Has that ever been appealing?
I don't on purpose.
Yeah.
Doesn't appeal to me either.
Yeah, really. That's a tougher path to entrepreneurship, I would think.
I think the risk isn't worth the reward when there's other opportunities out there for me.
So when you're talking about, like, Bob, you threw out the 10% growth number. Are you guys, when you're considering these businesses, being financially disciplined in terms of, okay, I have X amount of money that I can invest. If I put it in the S&P 500, I'm, can pretty much get this return, or if I can go the path of entrepreneurship. So is this really a look at, rather than a passion for whatever it is the business does, like most founders start, you're looking at this as an investment, as a return on your investment?
Absolutely. Yeah. I mean, the S&P historically is, let's call it 12%, right? So if you just bought an index fund, it'd be 12. If you're an active manager, you're going to be 12, right? So you can go that path. So if you think about it, risk adjusted, time adjusted, you're going to want to make sure that you have outsized. But if you're going to run the numbers after a session like this, you're going to go, holy smokes. The rate of return on your investment is astronomical. And the reason is that it's a highly leveraged deal. But you can leverage the deal because there's cash flow in the business already. So that debt service is covered. Not to get too technical in the finance. So basically what happens, you buy the business is buying itself. Right. So when you find a business in this level, you're going to find out that EBITDA is in $500,000 range, right? That tired founder is going to sell it at a low multiple because they just want to do this, right? They want to get rid of it. And now but what's great is you put your own capital in to some level, but I typically get seller financing. Some people disagree with me, but sellers will finance these deals at really incredibly good rates. And what they're doing is, to your example, is they're thinking, oh, wow, I have this cash flow for the next 15 years out of my business. Mm-hmm. They believe in their business. They believe in you. Remember, we just said you have to sell yourself. Mm-hmm. So they look at it like a bond. It's like a monthly payment that pays for their lifestyle. And they already have some money, so they're in great shape. So those kind of deals are perfect. So now you have the business is fairly levered, but the business is paying the monthly debt, even to the SBA loans, right? And so it's a pretty great deal because if you look at just what you invested and the total return, and then you grow it, wow, you cannot do that in the stock market. At least I can't.
No, and you can't. Very few people are in position to leverage their stock purchases as well. The vast majority of us are not getting 80 to 90% debt to buy an index fund in the S&P. It's so that's what makes it such an outsized return.
So are most of the deals seller finance then? Is that the more typical path, or are there a lot of sellers who are just like, I'm done and I'm out, I'm going to Florida and I never want to hear another word?
I think there's a lot of them that start with that mentality, but the ones that work with good business brokers will change their mindset on that, at least to a portion. I think, when I bought the wine and liquor store, portion 10, 15% seller financing, 80% bank financing. And the rest was my capital. I think I see a lot more of that where the sellers are holding a piece of the financing alongside the bank. And the bank likes that too, because it gives them confidence. The seller isn't just trying to dump this thing and run and hide somewhere in the Cayman Islands. They have confidence. They get that cash flow, which a lot of sellers too are not, even though they've run a successful business for years, they might not have been super sophisticated with their own personal finances. And so for them, having that consistent paycheck is sometimes a good thing. Like they know that they need that to not just go blow all their money on a trip right after they sell.
Right. So what I'm also hearing is that the person looking to buy a business needs to have good relationships with some banks in order to get that financing lined up at some point, right? Is that something you actively cultivate or is that not a problem?
Bob might be able to speak to it more. I don't necessarily think you have to go into it with an amazing relationship. Because if you're buying a good business, the numbers will speak for themselves. The banks will line up to fund it because that's what they do. They want their returns. And when I bought the wine and liquor store, I didn't have a relationship with the bank prior. I went to a couple of different bankers, and they all loved it.
Okay. So if the numbers are good, you won't have a problem with the financing.
Not really.
Not really.
As long as your personal credit score is okay.
Yeah. Absolutely. Well, you have to sell again. You have to sell yourself that you're the person to do it. I think that if you've been in business and you do this more than once, you're going to have bank relationships. We're the kind of people, the people who buy those businesses, the banks want to do. Think about it, we're great customers, right? We're going to use debt service. We're going to pay interest payments. We're going to, when you make money, they're going to manage your wealth portfolio, that kind of stuff, right? So I think the bank comes along with the ride sometimes, but I don't think you have to have a predetermined bank relationship to buy a business.
I usually suggest starting with the bank that the business is using currently too, because to Bob's point, banks make money when they're lending money. A lot of these older businesses aren't using debt service as much anymore. And so the banks hasn't made money on that business for a long time. And so they get excited. If there's somebody coming in to buy, they know that there's going to be leverage, they can make some money. So, and they've seen the cash flow of that business for however many years, it's an easier deal for them.
Gotcha.
When you're making an offer on a business that's not for sale, what does a legitimate offer look like versus people getting maybe spam emails or scammer type of things? What is your request to gain information and interest about a business that you want to buy?
Sure. Well, the process starts with a letter of intent. So, and a lot of people kind of get they don't understand a letter of intent, and it's probably good if you're not sophisticated to use attorney. Okay, but a letter of intent's not binding. So what's really crazy about this is basically I write a letter and I'm positioning myself as a great buyer for them. And I'm going to now what's difficult in the deal where if it's not for sale, there's no financials at all out there. So you're going to have to put some boundaries around that. But for the ones that are for sale, they'll give you some basic financials, right? So what you have to do is you have to assume they're correct, even though they probably aren't, right? And so for the purpose of a letter of intent, what you do is you want to get the seller to agree to the letter of intent because they've already started to emotionally disengage with the business and make a deal with you, right? So it's a sunk cost, right? So they start to invest in that process. But once you start getting real information, financials or supply chain information, or what it might be, patent information, whatever, then you can always adjust the letter of intent. And a lot of first-time people who are buying businesses don't realize how exhausting the process is going to be because from the letter of intent to close, you're going to be in a constant negotiation. Right, it's never fixed until you go to closing, and because you're going to find new information, you have to time that so that you don't spook the seller or be horrible to work with. But I like to write it so that it's defining what the economic parameters are. Are there things that we would walk away from the deal? We want to make sure that it's assuming these following parameters, whatever it might be. I don't even use attorneys for them anymore because they're so standard. But if you were starting, I would highly recommend sitting down with an attorney to understand the process.
So if the business isn't for sale, are you just making your best guess with this letter of intent, or are you initiating a conversation to get that information before you do it? Or?
Let me answer that from the opposite view from a seller, because I think there are people that might listen to this. They're going, "Hey, how do I sell my business?" Right? So the short version is one time I had a very comfortable business, and I had a meeting with a private equity firm. My business was not for sale. He brought a person who wanted to buy my business. So I hadn't even thought about it, quite frankly. And by the end of that lunch, we had an agreement. and it was because we talked about parameters, multiples, what deal financing would look like, what the concentration of customers were. I knew all those things as the seller. So you can go pretty fast. Now, it took 6 months to close the deal, right? Because all that, he had to do due diligence and he had to arrange for his financing, all those kind of things. But you can go pretty fast. So what was appealing to me was he was a highly qualified person. He came in through a person I had a personal relationship with. He sold himself that he could be the person to run the company. I built this business from, I did a small acquisition and built it up to be pretty large. So all those things were important to me. And I was at a point in my life that my son was about to go off and play football in college, and I wanted lots of free time to go watch him play ball. Okay. And so I think you just talk about general parameters. I don't know if you've ever done that.
Yeah, I agree with what Bob's saying there. That's everything is trying to get the parameters. I don't know if this is what you were asking originally either, but like I get emails all the time of people that want to buy my business, and most of those go directly into the garbage because they're extremely spammy. They're generic. There's nothing to them whatsoever. I have had people walk into the store that have asked if I would be interested in selling. Those, at least I might have a couple-minute conversation, except for the ones that go straight to my employees and ask if I'm selling the business. That's not a great way, because now we talked about sellers wanting to keep things quiet, but now they're spooking my employees for no reason whatsoever because I have no intention of selling anytime soon. So how you approach the person, like Bob said, the sitting down for lunch with a trusted intermediary introduction is the way to go. And then you get that information out of them versus just cold, nothing wrong with cold calling or trying to cold email, but making sure that you at least tailor it to their, what the business is, why you're interested in it, and those kinds of things.
Well, I'd say there is something wrong with the cold email if it's perceived as spammy and weird.
Yes.
The reason I was asking is from a seller's perspective. I'm not selling, but I get those emails, and they have varying levels of legitimacy. And I'm wondering, how do you know if it's one that would even be worth entertaining or something that is going to steal your data? That's the question. Yeah.
Yeah. I think it's that you got to have some kind of introduction, I think if you want to respond to them. Like I said, most the emails just go in the garbage. I guess I shouldn't have even said the cold email's okay. Just throw them all out. Take the phone calls and feel them out the best you can. Not handing over your bank details on that first conversation, I would hope, but
If we have a first-time buyer, right, somebody who's in the process, what are the typical mistakes they're making during due diligence? Like, what do you see people getting wrong?
Probably a lot. Just at the top, not doing enough due diligence, not digging in, not asking the right questions, just taking everything at face value, which, as Bob said earlier, initially you get some financials during the process. You have to kind of trust what they're giving you to make your offer. But then once you actually get into the due diligence, you need to tear everything apart, whether it's payroll, like going deep into payroll, getting the W-3s, getting all the employees' W-2s, depending what level of business it is, and analyzing their hours and what they're doing for the company, how long they've been there, utility bills, depending on what type of business it is, that can fluctuate a lot, or you can kind of insinuate things from certain utility bills. I was just talking to a woman who bought a laundromat the other day. You go backwards, you get those utility bills, and if the seller's telling you they're doing so much business, and you look at the utility bills and say, well, you only used 5 gallons of water last year for a laundromat. Like, how are you doing this much business? It's, so really, really going deeper than you think you need to go to verify everything. I'm sure Bob has plenty more.
Yeah, I think you're basically being a forensic accountant. You just are. It's not that you don't want to trust the seller, but sellers often commingle personal expenses. Then they try to tell you that, I'm going to, take that out of the business now. They'll tell you a lot of things that you just have to verify. And many times, I had the advantage of, I had a senior level procurement job when I was in the corporate world. So I did a lot of forensic work on determining prices of components before we entered into complex negotiations. So I'm pretty good at finding where the holes are in what they suggest as their financial P&Ls. But I want to throw kind of slightly different things. So let's assume that we did all this and we did it really well. I would say also on the due diligence, get a friend who is like a mastermind person, like, right? Who is going to not just go, yeah, go do it. Yeah. Like literally be like the devil's advocate to you. Like make it, find somebody else. I tell our MBAs all the time, yeah, they're in the classroom. My best business was Shelly Krishna, who was a grad student with me, and he became a very great friend. And he took care of the Indian side of our operation. I took care of the U.S. side, right? But I've had all kinds of friends in my life that really push hard on my due diligence, right? So I would suggest doing that. But the one thing I think people make the mistake the most on, let's assume all the due diligence, okay, not closing the deal. Because what happens is it takes a really strong behavior to close because you are personally committing to a large amount of money. It's really scary. If I bought a business today, I wouldn't sleep last night, right? It is, no matter how many times you do this, it is traumatic to you. So you have to build the psychological strength and a team around you that will encourage you and support you to do it, right? So I think the biggest mistake people make after due diligence is going, oh, there's a little bump, and that's the reason I'm out of here, right? But the due diligence is just the business is running. There should be a track record of everything, and if you do see something out of whack, it might be out of whack.
So have you guys ever walked away from a deal that you thought was going to be all the time?
All the time, plenty.
So people have to get used to that, right? That it's not one where you just go and you start the process and you finish it each time, but you'll
walk away.
You assume you'll walk away.
Far more often.
What usually makes you walk away?
Inconsistent financials, seller. Sometimes it's the seller that's not really ready to let go either. Like it's just, it's going to be too much of a challenge going into
They want to stay a part of the business.
Yeah, or I don't want to have to fight the whole way through doing the work, doing due diligence, and negotiating, but having to try to, you don't want to get into it and then the seller walks away because they realize 4 months in that they're not ready to do it either. Just to touch on Bob's point about having the right people around you, it's that balance of people that are going to help find all of the flaws and challenge you on your thinking, and then also the people that are going to support you and say, yeah, you know what, you can do this, you got this. Like there's everything else looks right. We asked all the right questions. Go close it, because it is easier to walk away than to get to the closing table.
Well, and I think you brought up a point, Bob, when you talked about the financials that, they may be running their personal stuff through the financials. But very often, when you're a business owner for so many years, you're trying to make your financials minimize your taxes, or you may be trying to make your financials look good for something else. So even, I'm not talking about doing anything illegal, but there's lots of different ways that you can present your numbers. And you're trying to get at something that's more repeatable for the future, not necessarily what they're doing. So, I want to make it clear that we're not necessarily talking about all these business owners that are cheating on their financials. It's just that there's different ways to present things, and you got to kind of dig through that,
Well, and there are legitimate things too that sort of seller, if a seller's going to conferences multiple times a year that are not really necessary for the business, but he or she likes to go to Vegas and Miami and London or wherever, there's certain things like that are legitimate business expenses, but maybe not necessary for the business on an ongoing basis for the way you're going to operate it. Or it is a necessary thing, but they're flying first class and staying in the Four Seasons where you could fly coach and stay at a Hampton Inn.
I think there's a few other things that maybe in due diligence to keep an eye out. Like customer concentration is one I look at. So if there is if a large amount of a business is a small number of customers, then you have to be very careful because they might have personal relationships with the person selling. I like where there's the customer concentration doesn't really exist. I want it to be pretty broad. That's one. I think sometimes there's things founders can do that are not repeatable. And so you want to make sure that you identify any of those kind of things. Real estate is another one. There's two very big schools of thought about whether you should buy the real estate or not. Most people try to segment it and say, would you buy the real estate on its own? I don't fall in that camp. What I do is I look at real estate. First of all, in SBA loans, if there's real estate, you can have a longer term loan, which lowers your monthly expense, so your leverage is better. But if I like putting the real estate in there, because if you picked real estate in a good location, you're getting appreciation in the real estate as well. And you're locking in that you don't have to worry about getting closed out of a lease in 5 or 10 years. So I liked having control over that. So that's worked pretty well for me because I think long term. So real estate is typically a good investment long term. And I'm the tenant, right? So I don't have to, it's not like I'm buying a commercial property where I have to find tenants. So some people disagree with me on that. They don't want anything to do with the real estate. It does sometimes take more capital because you have to include the real estate. But so there are some other things other than just pure financials that you would be looking for. And then I'll just always go back to I have to have some way that I know I can grow it, right? That I can open other sites, I can add marketing, that I can add AI components. I would not buy if I didn't see a clear path to growth.
What's a good amount to pay for a business? I mean, there's like we've all seen Shark Tank or whatever and heard stats about multiples of their gross revenue and stuff like that. What do you want to pay for a business personally?
Sure. It varies, but it can vary by industry a little bit. Usually Bob has mentioned the word multiple a few times. It's a multiple usually on the seller discretionary earnings, SDE, or the EBITDA, earnings before interest, tax, depreciation, and amortization. So depending on how well the business is being operated, depending on what type of industry it is in, you're going to use that SDE or EBITDA number and multiply it by anywhere from 0.75 to 5, 10, 20. I mean, I'm not in that category. I'm not going to pay that much for a business personally right now, but there are private equity companies that will. And that's kind of the goal, is grow it. To Bob's point earlier, when you improve the efficiencies of the business, you can also improve the multiple. So the less hands-on the seller is, the higher the multiple they're going to get. So I'm looking, I like the businesses where the seller is super active and they're in it day to day and they're taking a unreasonable salary, too high for what their job is. So I can take some of that salary, break it off, pay a decent manager, and some of that goes to the bottom line going forward, or to the debt service more likely. But finding those lower multiples is what I like, so that I can grow the business, improve the efficiency, and also grow the multiple at the same time.
Yeah, the crazy thing is that the multiple, it's typically a function of the industry it's in. Right. So the industry tends to dictate it. There's a little bit you can do in wiggle room there, but pretty much the industry picks the multiple, right? So that you have going in. So you want to buy below that number, right? So the first thing is that gives you margin for error. So if you can be below the industry, because you should be able to resell at the industry multiple. But here's the wild card. It's that private equity game. So private equity people don't want to do a deal if the EBITDA is only $500,000. It's too small. They won't put the time in. So if you buy a business that's $200,000 or $500,000 in EBITDA and you grow it to $1 million, you're now getting into where maybe private equity companies will deal with you. Private equity companies are going to pay, in today's world, probably 7 to 10 for that company that you bought for 2 or 3 for a multiple, right? So just if you start doing the math, this is for the people that aren't quants. Mm-hmm. So if you buy for 3 and sell for 9, you just tripled the value of the business.
And that's before you actually raise the EBITDA.
Yeah. Right.
So you have an opportunity to consider this a path, not just to buy a business and be the business owner, but a path to kind of, I don't want to say flip businesses, but to get an investment at a good price and then be able to turn around and sell it for a much higher price in the future if you do it.
And you should, I think you should, because think about what we've been talking about. You bought a business that was stagnated or reached a level that they couldn't go. Your expertise, your work took it from here up to here, right? So the premium for that, though, is sound. It's very good rate of return for your time.
So let's talk for a second about a business owner who already has a business and is operating it and wants to grow more. How does any of this change for an acquisition that would then have to be integrated into whatever it is that they're already doing? Or does it not?
I think it's a great path for growth for a lot of businesses. Certain industries it doesn't make sense or it's not fitting. Other industries like Jordan probably gets a lot of those emails because in a marketing professional service type industry, it makes sense because they're trying to grab more employees, they're trying to grab bigger client lists, and the multiples are usually lower in those industries as well. So why not grow faster by acquiring? In wine and liquor, it doesn't make any sense because, especially in New York, I can only own one store anyway, and buying a store 4 miles away and trying to merge it isn't going to make any sense. So it's not fitting for me necessarily here. Maybe in other states, I could build a franchise system, but depending on the industry, I think it's an amazing opportunity to grow your business at a faster pace than just organically.
And so somebody who's at that plateau and maybe doesn't want to sell, this could be the avenue that they should really be exploring.
I'd say so.
Sure. I mean, M&A is certainly a good technique. The difficulty is you have to be good at the integration of two companies, and culture gets to be the thing, right? So sometimes, what you do as a business owner, especially a firm in the range that I look in, is I go, wait a minute, I don't need that complexity. I can just grow, right? I can grow to the number I'm shooting for without doing that. But I don't see any reason why you wouldn't use it as a strategy. Certainly fine.
Yeah, the culture, I think, is the biggest challenge with those types of growths. I know people that have tried in the childcare industry that just when you don't get the right, you're buying it for the employees and the customers, but when you buy it and you realize that the employees are not fitting in your culture, it's kind of pointless. You're starting from scratch anyway.
Really hard. And anyone that's been in the corporate world has probably been part of some form of merger or something, if you've had any career at all. And everyone's going to know, wow, really hard.
Yeah.
Very hard to do.
I'm part of a few of those. Well, we are running short on time here, but I want to end with a final question that, okay, if there's someone listening to our podcast today and they're currently in a corporate role, they're not entrepreneurs, but they're thinking they'd like to be, they want to buy a business, what is the one hard truth you want them to understand?
The day you buy the business, be prepared to work like you've never worked before. It is emotionally hard and physically hard. So many people go, I'm going to do all this analysis. I'm going to buy a business. I'm going to the beach and just cash the checks. So we're telling you that the profit and the cash flow from the business can pay the debt service and pay you for your time. But you have to operate the business. And I think what a lot of people do is if they close and they go, I'm just going to be the boss kind of thing. That's not true. The way we look at it is the first year is we're learning the business. We are preparing the team for growth and the operation for growth. In year 2 and 3 is when we start to really pour the gas on for growth. That first year, you're just overwhelmed with learning the business, meeting employees, meeting the supply chain, learning about the customers. Your 20-hour days will be a short day. So that's where a lot of people don't understand how hard it is to do all these things. We're making it sound easy, but we put in enormous time and we have decades of experience doing these kind of things. So the corporate people will have the experience, just get a lot of rest ahead of time.
Yeah, on that note, when I was buying the wine and liquor store, I met somebody a couple months before I closed, and the person said, you're getting into retail. That's awesome. He's like, you get to work half days. And I was looking at him a little bit confused, and he's like, yeah, half days, 12 hours a day, 7 days a week. That's what you're going to be doing for the next, so many years. And it wasn't that bad, but it was rough, especially the first year. I think the biggest thing is that it's not there's no finish line. It's an ongoing process. So from due diligence, you make the offer, you're searching for a business, you make the offer, you're doing due diligence, you get to the closing table. There's no finish line, probably until you sell the business 10, 20 years down the road or whatever it is. And even then it's not really a finish line. It's all a process. It's all a journey. Enjoy the whole thing and don't think that it's going to be done at a certain point.
So a lot of entrepreneurs always say, it's more work than you ever imagined, but they wouldn't have it any other way. So
you have total freedom. It's your business. And if you are successful at it, your family now has financial freedom. You have a way to live the life the way you want to live, right? So, we're kind of hardwired for that, right? If that doesn't suit how you want to live your life, that's probably a bad path.
Gotcha. Well, Tim and Bob, thank you so much for helping us unpack what was a very complex but a really powerful discussion today. I love the idea that folks listening to this can see a different path to entrepreneurship than maybe what they knew traditionally existed. So buying a business it's not just a transaction, it's a leadership transition, it's a strategic commitment, but it can be a faster route to scale an enterprise value when done thoughtfully. So if you've enjoyed this episode, if you've enjoyed learning about how to acquire a business or maybe expand through acquisition, please follow the show, leave us a review, share it with someone else who's might be considering business ownership. I'm Susan Steffen. This has been the Incorporate podcast. Until next time, keep learning, keep building, and keep thinking strategically about how you can grow your business.